If you go back on that dollar chart, you'll see that it had a surge high that got up to 100 back in late 2015 when gold made its low in December of 2015. You see that surge there, right there, yeah, right about there.
Yeah,
No, wait, yeah, that surge. You closed in December of that year when gold was making its low at 1,050.
I
The
remember that. Yeah,
dollar index was in the area of 98. Okay, where are you now? In that same area. So
yeah,
in other words, if you're looking at the dollar as your sole metric to judge gold, you're wrong. Because
yeah.
gold has doubled and almost tripled. Yeah, no, it's tripled um,
Well, the low
since
in
2000. Yet the dollar's not moved. As far as the stock market, I'm having deja vu. Okay, MSA's been around since 1992, servicing institutional clients, major fund managers, and so forth. And then we opened to retail market in 2015, I think it was. But we look at all four asset categories, and the stock market is really important now, we think, because usually when the stock market breaks, that's when you get the data points to go south. In other words, all the Powell's sitting back saying, well, everything looks good, et cetera, et cetera. Well, it's hardly ever the case when the stock market peaks and heads into a major bear that the data points warned you ahead of time in any big way. Those usually come, a handful of months after the high, then suddenly all hell breaks loose. Okay. Now, technically speaking, though, let's get to what we do. Yes, we look at price, but it's secondary to us. We've long learned that price is often delusional, particularly at trend change times. Whether you're making bottoms or tops, quite often it's confusing to the guy who's looking at the price chart because the price chart looks either, oh, it's still weak, or oh, it looks like it's going up forever. Momentum will tend to almost always break its prior trend prior to price breaking a similar prior trend. Whereas you look at the price chart, you don't see the breakage. Look at the momentum chart, say, oh, it broke. Okay. What happened in January on the S&P, barely coming off of its late 2024 high, it broke enough quarterly momentum trend structures in our work. Now, what does that mean, quarterly momentum? That's when we measure price in its relationship to a three-quarter average, which is a fairly long-term average. And it doesn't matter whether you're above or below the average necessarily. It's the structures that you build visually. When you look at the momentum chart, you see like what you see on a price chart, except usually price doesn't show it at that time. We broke major structure and we paid dues into April. The event started to unfold about a couple of months after our breakage point. We've now come back, and I've been hoping personally, and I've even mentioned it in the reports, that don't be surprised by a new high. It's highly, highly likely to be false, deceptive, and a trap. Okay. Now, when we go back, I said deja vu. Back in 2000, we had the dot-com top. At that point in time, in January, in fact, the first day of the year, we put out a report saying, get out, it's over. Okay. And we had a sharp break right after that. It dropped into like February, dropped like 10% or so. It was a pretty sharp break then. And by March, it came back up and made a marginal new high by a handful of percentage points. And so everybody thought, well, boy, is he wrong? etc. We said, no, the structure was broken on momentum. Price is making a new high, but it's a trap. And it fiddled around up there, either side of our January sell point. Again, this is the dot-com top. And in August, it finally went up and made a new high monthly close as well, not just an intra-month high. Still not very far from the January sell point, but holding. So naturally, anybody who's long, their fear is abated. Why? Because every time it tried to go down, it wouldn't go down. And therefore, oh, this is great. And then later in the year, it sagged off again. So by the end of the year, you're actually headed down a bit. And in January of 2001, the Fed would cut rates twice. They'd been on a hold pattern for over a year. I think, no, for a year. And then they started cutting rates twice in the same month. And you were already somewhat off the high at that point. And it's only then that the real bear market started to show itself.
History doesn't repeat, but in markets, it sure does rhyme. From the dot-com bust in 2000 to the subprime chaos of 2008, each major stock market crash was preceded by deceptive rallies and calm data. Investors assumed the economy was stable because the markets looked strong until they weren't. Today, we're seeing a repeat of those same misleading signals, with new highs forming on broken foundations. While prices may fool the average investor, momentum tells a different story. Unlike simple price trends, momentum tracks deeper structural shifts. In early 2024, key momentum indicators broke trend well before price reflected the damage. These fractures aren't visible on most charts, but they mirror past warning signs from 2000 and 2007. What looks like a healthy market may already be bleeding internally.
In early 2001, and of course it dropped 50%. Nasdaq 100 dropped 82%. Okay, huge bear. Okay, again, confusing and laborious high. Go back to 2007 now. If you've ever seen the movie Big Short, it deals with three or four guys, analysts who were sort of outside the mainstream of Wall Street, who perceived, analyzed, and said, there's a problem here. It's a crisis. This mortgage situation is going to blow up. Nobody believed them. They were laughed at. It was a great movie in that regard. It was a true movie, too. They must have been pounding their heads into the wall because they assessed the market in 2005, 2006, 2007 as it's no good. Okay. And it took till 2008 before they finally got, they were vindicated. But that's a laborious top. You made a high in May of 2007 at around 1550 plus a few points over 1550 on the S&P. By the way, the old 2000 dot-com high for S&P was also 1550. Okay. We went up and basically they sold that high. You had a sharp drop into August. In other words, anybody who was looking for a top got a sharp drop. And then suddenly in August, it turns up. September, mid-September, the Fed cut rates in an ambush way. Nobody expected it. Half a point. About 3 weeks later, it pushed up into October and took out the May high. So what do you get? May, June, July, August, September, a 5-month span there. And which also took out the 2000 year price high. So on a price chart basis, you've got to be pounding the table. It got to 1575. 25 points or about 1% above those dual highs. So anybody looking at a price chart would say, oh boy, look, it's a breakout. Okay. That was it. Tombstone was placed right there. And then the bear market started. I mean, it really didn't unfold hard till later 2008. But again, complex top, meaning laborious, new high involved. But momentum says, it's not valid. It's a trap. We're in that same position now in our assessment. When the market broke, gave us our signal in January for the S&P and early March for the Nasdaq. We had the sharp drop, but we had in MSA, we put out a report warning there's going to be a bounce point. And we defined it as 4,800 for the S&P and 16,500 for the Nasdaq 100. That's where they stopped, within decimals either side of those numbers, and rallied. And over the last, 2 months, it's been an inching type rally, where it's not been explosive, it's just been creepy crawly. And now over the last 48 hours, S&P and Nasdaq have made new highs. So everybody's saying, oh boy, it's on CNBC, Fox Business. So everything's okay again, right? No, we argue, no, this is a trap, price trap. Momentum says you broke your shin bone and your hip bone in that recent break. And the next time you turn down, you're going to break your backbone. Do not trust this rally. Why is it significant? If we're topping, and we are, money will flow elsewhere. It always does. In the past, whenever you look at the S&P enter a bear market, if you look over at T-bonds, oh, it's a place to be. It actually goes up. Yields go down. Gold also. Those two are the alternatives. This time around, it isn't. It's only gold. T-bonds are stuck in a mire, not far from the high end of their rates or the low end of their price action. So when the money flows, when you roll over again in the stock market, and I think we will, and I think you'll see the evidence of that probably early in this new quarter, okay? When you start to see that rollover, watch the money flow, because I'm going to bet that it gooses gold and the monetary metals in a more exaggerated upside manner, more vertical rather than arm wrestling. And you'd mentioned another thing, dollar index. You want me to get into that? Okay.
Yeah, yeah, definitely. And it seems like very similar then to what you were talking about in 2007 and 8, because we even in '08, I hadn't realized we broke the all-time high like from 2000, and we're doing the same thing now. And yeah, the dollar index, I don't look at momentum. I do when I get my research from you, but I look at charts a lot, and I've got this monthly chart from like '08 till now, and there's a like a upward channel, and
Mm-hmm.
we're just testing the lower bound of that trend line or that channel. It's at 97.50, and it doesn't look good if we close the month below that level. Is that
Yes.
the same thing you're seeing
Yeah.
for momentum? And
Yeah.
how would that
Yeah.
affect also treasuries, you
Everything.
think?
Well, I mean, you got four major asset categories. You got government, you got debt markets. Okay. You got stock markets. You got the commodity category, also with the monetary metals component of that. And you have Forex.
Let's revisit past market tops. In 2000, a false breakout after a sharp dip confused investors before the crash. In 2007, another trap lured buyers right before the financial collapse. Today's eerily similar, creepy crawly rally has brought the S&P and Nasdaq to new highs, but beneath that surface, momentum has collapsed. Just like before, many will only recognize the danger once it's too late. As stocks show signs of topping, capital will flee. But unlike past cycles, treasury bonds aren't the safe haven they used to be. This time, gold is king. The dollar index is breaking multi-decade momentum channels, setting the stage for a steep decline. Meanwhile, gold has decoupled from dollar strength, tripling in price since 2015 even as the dollar index remained range-bound. The next market rollover could send precious metals skyrocketing.
But if you look at a dollar index chart, like your monthly, for example, and you go back, it made a high in 2022 and dropped sharply into late 2022, early 2023. It got down to 100 level. Oh, you pop it, yeah. You can see that surge there to 115 that occurred, yeah, that second yeah, peak over there. You had the sharp drop into early 2023, then a bounce, then a rally, then a bounce, just stuck in a mire, about a 7% range for 2 years plus. Okay. You tried to break out upside, and we warned that when you broke out above that little range there, you nipped above it for a month or two. We said that's a trap, don't believe it. Okay. Sure enough, in March, which is this first big red candle you got there, the biggest of the two, yeah, there's two big red candles. The first one is March. It closed that month at 104.21, right in the middle of the price ink. Okay, so it didn't break through the lows, but annual momentum blew a comparable channel to the one you see on price. It did it at 104 area. Since then, price went down, took out all those lows around 100. It got down to 97 yesterday and today, intraday. When we turn to an even longer term annual momentum chart using a 10-year moving average of the dollar, plotting the oscillator looking for trend structures, not just crossing above or below that average. It is breaking a trend structure that goes back to the 1970s. Okay, so it is a huge, ugly trend channel. And therefore, momentum is saying, yeah, you've now dropped to the bottom of your price channel. Probably that price channel is not going to hold because already the momentum, 3-year average momentum, 10-year average, are breaking their structures. And what we need to complete the 10-year average momentum breakage is to close any month this year below 98.35. Right now, you got 1 day left in the month, and we're trading 97.10 as we speak. Okay, so you got a problem.
Is that the future? Because
I use the cash only, cash
yeah, because
index.
I've got here 97.35. I'm not sure if this is
That could be cash. It may have just
yeah,
bounced some.
yeah.
Yeah, but it's
So
still it's
I
well below that number. Yeah,
we'd need a big rally for the dollar on
and
Monday.
yeah, on Monday. Yeah, right. If you close below 98.35, credibly, let's say, and you're credibly below it now, yeah, you're on the price channel, and you'll notice for the last few months as you approach that channel, there have been buyers thinking, oh, I'm going to buy channel bottom and make some money. Well, they've been buying it. You got down to under 98 2 months ago in April. May had a mild nothing bounce. Then this month is down again, new lows, 97. And you're squarely on that channel, which is a valid price channel, by the way. I think it's a valid technical feature, but it's lagged to its own momentum. Its own momentum says, no, you're broken. The other way I'd look at that rather than drawing that downtrend, see the collapse from the upper left to that 1982, 1991, 92 level? That's a first major leg. Then you have a second major leg, and I bet you're about to have a third major leg. And it wouldn't shock me that the lows you see there are coming out in the
Oh,
next year.
the
Yeah, in the
low
70s. Yeah,
yeah.
in the 70s.
So
Now
you
remember, this is not a real valuation of the dollar.
no, it's just against the
Yeah,
euro
it's
and
other
some other
fiat junk, so
yeah.
the euro and the yen constitute 70% of the dollar
Yeah.
index.
It's
So
not.
it's measuring, skata versus skata,
Yeah,
okay?
should I bring up gold? Do you wanna?
If you want, yeah. And
Yeah,
another point there is that if you go back on that dollar chart, you'll see that it had a surge high that got up to 100 back in late 2015 when gold made its low in December of 2015. You see that surge there, right there. Yeah, right about there. And
yeah.
no, wait, yeah, that surge. You closed in December of that year when gold was making its low at 1,050.
I
The
remember that. Yeah,
dollar index was in the area of 98. Okay, where are you now? In that same area. So
yeah,
in other words, if you're looking at the dollar as your sole metric to judge gold, you're wrong
yeah.
because gold has doubled and almost tripled. Yeah, well, no, it's tripled um,
Well, the low in
since 2000. Yet the dollar's not moved.